Imagine running like a retail business where foot traffic drops by 10% in your biggest market.
Right.
Your overall customer base is literally shrinking, and yet somehow your quarterly revenue still hits nearly $1 billion.
Yeah, it defies basic business gravity, honestly.
It really does. So today, for you listening, we are looking at an automotive technology company that is pulling off exactly that kind of magic trick.
Which is a wild paradox to look at on paper. I mean, historically, the rules of automotive manufacturing were pretty much written in stone, you know?
If car production goes down, your revenue goes down.
Exactly. The suppliers who make the parts for those cars lose money. It was an inescapable one-to-one correlation.
But those rules are, well, they're being rewritten as we speak. To understand how, we're unpacking a stack of freshly filed sources today. We have Visteon Corporation's SEC Form 10-Q and their Q1 2026 earnings press release.
Both dated April 23, 2026.
Right. Okay, let's unpack this. How does Visteon achieve $954 million in quarterly sales when fewer people are actually buying cars? The answer requires taking an inside look at the digital revolution happening right inside your car's dashboard.
And, you know, that $954 million top-line number really is the anchor point for this entire discussion, mainly because the broader economic environment they're operating in right now is, I mean, it's incredibly tough.
Yeah, let's lay out those seemingly contradictory facts from the press release. So global light vehicle production dropped 3% in the first quarter of 2026.
Right.
And if you look specifically at the production for Visteon's core customers, it was actually down 4%.
So the pie is undeniably shrinking.
Exactly. The pie is shrinking. Yet Visteon's sales increased 2% year over year. They delivered what the company calls a growth over market of 3%.
And when you break down those production numbers by region, the divergence becomes even starker. I mean, vehicle production in North America was down 2%. Europe was down 1%.
And China, right.
Yeah, China, which is an absolutely massive growth market for the entire industry, was down a staggering 10%.
That's the part that really tripped me up. I was like,
Yeah.
trying to think of how to visualize this for you guys. It's like, okay, it's like a movie theater reporting record snack sales during a month when box office attendance is just in the gutter.
Oh, I like that.
Right. Like they aren't getting more people in the front door. They're just aggressively upselling the ones who do show up, getting them to buy the massive $20 premium popcorn bucket instead of the basic size.
That perfectly captures the upsell. But the mechanism of how they do it is what's truly shifting the industry, because in Visteon's case, that premium popcorn is digital real estate.
Ah, okay.
Right. So even though fewer physical cars are rolling off the assembly lines, the cars that are being built are packed with far more advanced, far more expensive cockpit electronics. The physical volume of cars matters way less now than the dollar content per vehicle.
Because they aren't selling like basic plastic speedometers with physical needles anymore.
No, not at all.
If you look at the product mix details from the SEC filing, the numbers are huge. Instrument clusters brought in $475 million. Information displays were $148 million.
And infotainment systems were $116 million.
Right. That digital hardware is the bulk of their revenue.
What's fascinating here is that they are capitalizing on a fundamental architectural shift. The perceived value of a vehicle, at least from the consumer's perspective, is migrating from the engine blocks straight to the dashboard.
Yeah, the screens are everything now.
Exactly. And the Q1 press release illustrates this perfectly. They executed 20 new product launches in just the first quarter, spread across 11 different customers.
And these aren't budget brands either. Major premium automakers are relying on Visteon for their interior redesigns.
Yeah, big names.
Like they had their first launch with Lexus, putting a new driver display in the fully redesigned Lexus ES. They launched a digital cluster on the all-new Infiniti QX65 crossover in North America.
They even integrated a display cluster for the electrified Ford Bronco in China.
Wow. So every time an automaker upgrades a cabin to feature, a larger screen or a more complex digital cluster, Visteon captures a larger share of the overall cost of that car.
Which completely decouples their revenue potential from the raw number of cars being manufactured.
Okay, I follow the logic there. They are selling the bigger bucket, capturing more market share per car. But, and here's the big but, if you are selling higher value premium digital items, you should be rolling in profits.
Right. You would think so.
But grabbing all that extra market share isn't coming cheap. Let's look at the friction between their rising revenue and their falling profitability, because the financial statements paint a much bleaker picture than the top-line sales figures do.
Yeah, the cost of delivering that expansive digital real estate has escalated dramatically.
The facts here are tough. Gross margin fell from $138 million in Q1 of 2025 down to $113 million in Q1 of 2026.
A significant drop.
Yeah, and net income took a massive hit, dropping from $69 million down to $33 million, with $31 million of that attributable directly to Visteon. And their diluted earnings per share nearly halved, dropping from $2.44 to $1.14.
It's a very sharp contraction in profitability, driven by several converging macro factors.
But here's the thing that really caught my eye. On top of those shrinking margins, there is a significant $18 million net restructuring expense right there in Q1.
Right, the severance.
Yeah, the filing notes it's primarily for employee severance to rebalance resources. Now, in the very same press release, the CEO talks about delivering solid operational performance. So what does this all mean? How solid is an operation that has to spend $18 million just to fire people and rebalance? They're making more money at the register, but their actual take-home pay has been slashed.
It sounds contradictory, I know. But if you examine the supply chain realities detailed in the 10Q, the margin compression is largely exogenous.
Meaning outside their control.
Exactly. It's not necessarily a failure of their internal operations. The filing explicitly points to elevated semiconductor and memory chip costs as a primary culprit.
Wait, hold on. We've been hearing about automotive chip shortages since the pandemic. Is the industry really still dealing with the exact same problem 4 years later?
Well, it has mutated into a completely different beast. It's no longer a general manufacturing bottleneck.
No.
Today, automakers and automotive suppliers like Visteon are locked in direct competition with artificial intelligence data centers.
Wait, what?
Yeah, they are fighting for the exact same memory chips.
Wait, really? The screen in my neighbor's Lexus is fighting for parts against a massive AI server farm.
Essentially, yes. The foundries that fabricate these chips are looking at their own margins. If you manufacture silicon, do you allocate your wafer capacity to legacy automotive chips with tight margins?
Probably not.
Right. Or do you dedicate it to the massive, highly lucrative data centers being built globally to train AI models? The supply naturally flows toward the higher margin, which is AI. Consequently, the cost of the remaining chips available for the automotive sector skyrockets. Visteon is absorbing that premium.
And the SEC filing also neutrally documents other macro pressures weighing on costs too, like the uncertain impacts of geopolitical conflicts in the Middle East potentially disrupting supply routes.
Yeah, that's a big one.
Along with the looming potential of new tariffs, those external factors all squeeze the gross margin simultaneously.
Which brings us back to your point about the $18 million spent on severance. It's really tempting to view that purely as a distressed move to stop the bleeding.
Right, like they're just cutting costs to survive.
But in the context of an evolving tech company, restructuring is often a strategic realignment. They are actively pivoting their workforce to match the new technology they need to build. And crucially, Visteon is absorbing all these external shocks while retaining a very strong balance sheet.
Yeah, I saw they ended the quarter with $385 million in net cash.
So they have the financial cushion to take the hit on margins now, pay out the severance, and reposition the company for the future without going into heavy debt.
Let's dive into that pivot then. Because if they are spending $18 million to realign, where exactly are they pointing the ship? We already established they aren't just molding plastic dashboard dials anymore.
Right.
They are transforming into a software and user experience hub.
And whatever they are doing, the market is validating the strategy. They recorded $1.0 billion in new business wins in just the first quarter.
Hold on. $1 billion in new business in 90 days?
Yep.
Their entire revenue for the quarter was $954 million.
Yeah.
That means they are booking more future business in one quarter than they are currently fulfilling. How are they physically securing that kind of volume?
It comes down to a technology called the Smart Core High Performance Compute, or HPC, domain controller.
Okay, the Smart Core.
Yeah, the press release highlights this as a major momentum driver. They secured a massive win with a premium Chinese OEM and an original equipment manufacturer, meaning the actual car brand for an AI-capable smart cockpit.
Oh, wow.
And this was their third such win in China, alongside another Smart Core win for vehicles in India.
I want to break down why this domain controller concept is so revolutionary, because it literally changes the DNA of the car. Think of older car architectures, like a massive orchestra where every single musician is playing a different song without a conductor.
Oh, that sounds chaotic.
Right.
Yeah.
You had a separate tiny computer, an electronic control unit for the radio, another one for the speedometer, another one for the air conditioning. It was fragmented, heavy, and horribly inefficient.
A perfect analogy. A domain controller like SmartCore acts as the maestro. It centralizes all of that scattered computing power into one powerful brain.
Right, so they're not all fighting each other.
Exactly. Instead of 70 different computers fighting for resources, you have one high-performance system running everything. It allows the car to function much more like a smartphone, where different apps, screens, and sensors seamlessly communicate with each other in real time.
Here's where it gets really interesting, though. To make that smartphone-like experience actually work, to make it fluid, you need incredible software and user experience design. The hardware is just the shell. This brings us to a fascinating detail buried in the SEC filing. In May 2025, Visteon acquired a user experience, or UX, electronics engineering consulting firm, for $55 million in cash, plus up to $9 million in contingent consideration.
If we connect this to the bigger picture, that acquisition is the missing piece of the puzzle.
But historically, hardware companies absolutely struggle when they try to assimilate a software culture. It's a completely different language.
Oh, it really is.
Hardware is about rigid manufacturing tolerances, supply chains, and Six Sigma quality control. Software is agile, iterative, and constantly changing. Is a traditional auto parts manufacturer really trying to transform into a Silicon Valley software company just by throwing $55 million at a consulting firm?
Well, consider the alternative. They really had no choice. The physical hardware, the glass screens, and the plastic housings are rapidly becoming commoditized.
Meaning anyone can make them.
Exactly. Several suppliers can manufacture a high-definition screen. The unique value, the specific feature automakers are willing to pay a massive premium for, resides entirely in the user experience.
Like, how intuitive is the interface?
Yes. Does it lag when you swipe? How well does the voice control integrate with the ambient lighting? Does the AI anticipate the driver's needs?
So they bought the capability rather than trying to build a software culture from the ground up inside a traditional manufacturing environment.
Look at the SEC filing data to see exactly what they bought with that $55 million. They didn't buy physical factories or warehouses.
Right.
They recorded intangible assets, $32 million in customer-related assets, and $5 million for a trade name. It was a calculated shortcut to acquire relationships, credibility, and proven UX talent.
And they needed that shortcut to compete in markets like China.
Yeah.
Consumer tech expectations in the Chinese market are notoriously sky-high.
They really are.
If a car's dashboard screen isn't as fast, responsive, and intuitive as the latest smartphone, consumers there simply won't buy the vehicle. The tolerance for clunky automotive interfaces is zero.
And the timeline is far too compressed for Visteon to organically build an elite software culture over 5 years. The market demands AI smart cockpits right now. Buying that UX consulting firm was the exact fuel they needed to immediately bid on and secure that $1 billion in Q1 business wins.
Okay, we've analyzed the tech, we've looked at the corporate strategy and the billion-dollar order book. Let's ground this in reality. What does this tell us about the end consumer? You and me. And how is the company managing its actual cash flow while they wait for the market to stabilize?
The consumer demand side is the engine driving this entire transition. Automakers are only asking Visteon to build these systems because consumer preferences are shifting.
The press release notes that U.S. retail demand remained fairly resilient, staying above 16 million units on a seasonally adjusted basis. But what is making up those 16 million units is shifting.
Right, the mix is changing.
The volume is being driven by internal combustion engines and hybrids. Meanwhile, the EV market specifically saw purchases decline. The filing notes this followed the expiration of federal EV tax credits.
It highlights how deeply policy changes impact consumer behavior. The expiration of those tax credits immediately cooled EV sales momentum. Automakers have had to adjust their production schedules rapidly, pivoting capacity back toward hybrids and traditional gas vehicles to meet where the consumer's wallet currently is.
And yet, despite that market whiplash, despite the overall slump in global vehicle production, and despite laying out $18 million in severance while battling high chip costs, Visteon still returned $40 million to shareholders in this exact same quarter. That breaks down to $30 million in stock repurchases and $10 million in cash dividends.
That's significant.
They also reaffirmed their full-year 2026 guidance, projecting sales between $3.625 billion and $3.825 billion. That feels like a massive flex of confidence.
It does project a massive amount of operational confidence.
But I keep coming back to that tension. You don't authorize $30 million in stock buybacks to project stability if you're internally scrambling to fire people because of supply chain shocks. Aren't those two signals at war with each other? Or is it just keeping investors happy?
This raises an important question about corporate financial maturity and how companies utilize their balance sheets during transitional phases. The $30 million in buybacks isn't a sudden reactive decision to distract from the halved earnings per share.
Okay, so what is it?
The filing details that this is part of a larger $300 million buyback program authorized way back in March 2023.
Oh, I see. So they are just executing a long-term plan, regardless of the quarter's specific turbulence.
Buying back stock during a transitional period, especially when margins are temporarily squeezed by exogenous supply chain issues, is a structural tool. It supports share value and signals to the broader market that leadership fundamentally believes the long-term tech strategy is intact.
Right.
They are essentially saying, we have $385 million in net cash, we have $1 billion in new orders, we are not panicking.
And regarding that EV slump we mentioned, I realized something looking at Visteon's diverse product portfolio. They are uniquely insulated from the policy whiplash surrounding electric vehicles.
Oh, how so?
Because their technology is powertrain agnostic. If a consumer decides to buy a traditional gas-powered Lexus ES, Visteon supplies the driver display.
Ah, right.
If a consumer in China decides to buy a fully electrified Ford Bronco, Visteon supplies the display cluster for that too. They don't have to bet on which engine technology wins the decade.
That is a vital strategic advantage. While the major automakers are agonizing over whether to invest billions in a new battery plant or update an existing engine plant, Visteon is comfortably waiting to install the digital dashboard into whatever vehicle eventually rolls off the line.
Exactly.
Their high-performance compute technology and UX design are necessary for the software-defined future of all vehicles, regardless of what is spinning the wheels.
That is a phenomenal, highly defensible position to hold in an otherwise chaotic industry. So to wrap this all up, Visteon serves as the ultimate case study of the modern automotive landscape.
Absolutely.
They are a company successfully selling a more expensive digital future, the massive premium popcorn bucket, even as the present-day market produces fewer physical cars and battles intense supply chain costs with AI data centers.
They are acting as the crucial bridge between the traditional metal-bending automotive industry and the high-margin, software-driven tech industry. It is a difficult transition, hence the restructuring and margin pressure, but the billion-dollar order book suggests they are successfully crossing that bridge.
So why does this matter to you? Think about what happens the next time you get into a new car. The glowing screen sitting in front of you isn't just a speedometer or a navigation map anymore.
No, it's so much more.
It is a literal battlefield where global supply chains, cutting-edge AI technology, and multi-billion-dollar corporate pivots are all clashing at once. It has become the most valuable real estate in the entire mobility sector.
And as we move further into this reality, as vehicles complete this transition into software-defined computers featuring these AI-capable smart cockpits, a massive new issue emerges.
What's that?
Well, those centralized systems are going to be constantly tracking user behavior, eye movement, voice commands, and daily driving habits, which leaves us with a lingering thought not explicitly solved in these SEC filings.
Okay.
As these digital dashboards become the brain of the car, who ultimately owns the incredible amount of data being generated by your daily commute? Is it the car maker, the tech supplier like Visteon?
Or the driver?
Oh, wow. That is the multi-billion-dollar question for the next decade of automotive tech. Keep that in mind the next time you connect your phone to your car's dashboard. Thanks for joining us for this deep dive. We'll see you next time.